So I'm staying long my silver, and I like silver even a little more here, given the news. I think this move is going to secure more seats for him, right? By putting Waller
Yeah.
on.
Because Waller's already on the FOMC Board of Governors. And so this adds him another voice. And once Powell leaves, Trump will have appointed 4 of the 7 governors at the Fed.
So I think this is a situation where it's good for gold and silver because the Fed governor change, it's not necessarily going to change the economic backdrop, but it's potentially going to bring rate cuts in, potentially more. So I think it's a really good outlook for gold or silver. I'm probably going to get long gold as well here coming up soon. But as long as the economy is doing well and you're getting, a slightly more dovish Fed, I think this looks good for both of them. And I think the price action is reflecting that.
So we're going to have growth in inflation a little bit up, but still positive real GDP on the other end of it. It's not quite stagflation, although it smells like it, Ilya.
Yeah.
What do you see here? I mean, again, this is perhaps the most important development of the afternoon. Bonds really unchanged.
Mm-hmm.
Okay, but gold, silver, Bitcoin all up on the back of this Mirren announcement. If I recall correctly, Stephen Mirren's one of the folks who's behind the formula,
yes,
the famous August 2nd formula about how they arrived at their tariff rates. So I don't know if that helps inform anyone about where Fed policy may be going, but I think it's certainly informative. Ilya, what does this tell you? What is Mirren's appointment and the reaction that you see immediately on the other side of this with the dollar index, gold, silver, Bitcoin? What does it say to you?
I mean, I think there's a couple of things you look at here. So the first thing is that it's probably encouraging for not creating a shadow Fed chair. There was a conversation out there that maybe what this Kugler vacancy will do is let the president nominate the person who he wants to replace Powell next year, to do the song and dance on Senate confirmation now, if that's necessary. But more importantly, to have that person in the room starting to shape conversation and really give a sense for just how much influence the fiscal side is going to have over monetary policy once Powell is out. And sort of to put a dark horse directly inside the FOMC. This is not that. In fact, the president hasn't mentioned Stephen Mirren in any of his conversation about the Fed chair, and said, we have the Kevins, we've got Waller, and one more, whoever that is. The Kevins being, of course, Kevin Warsh, Kevin Hassett. And maybe that one more is Bowman, since she has been an increasingly vocal voice for rate cuts. Who knows? Bowman, by the way, would be a little bit of a coup. We know the president likes doing things to kind of poke the other side in the eye a little bit and go, ooh, I nominated a woman, but you won't give me those kudos, whereas you'd give them to yourselves. Ha, 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 ha. So that's a thing. If we look at, I think, what this announcement is and how the president's talked about it, this is keep the seat warm until the end of the term kind of an announcement. And so I'm not sure it speaks to intent.
Don't you think the lack of job security is intentional?
Yes. Yes.
I mean, I think that's a read through here. Mirren's only a temporary appointee. Trump can swap someone else on there once the term ends if Mirren doesn't impress him with his decision making.
Well, yes, and we know the president wants rate cuts, and to his credit, so do markets. The markets want these cuts. The Fed funds futures structure, in particular for next year, is 50 basis points more dovish than what the Fed has as of June. So it's not like the president is out on a life raft out here screaming for things that nobody's thinking about or wants. No, the markets actually agree with him. They want these cuts.
Yeah, well, that's why we did the Futures Power Hour episode on Friday called President Trump Was Right.
Yeah.
Because the market is saying that we need recuts. And when you look at the data, but for OER coming in, but for the tariffs, you would see that OER coming in. It probably means that you'd have lower inflation readings if you look through the tariffs to a certain degree.
Mm-hmm. Yeah.
And we know that core GDP is falling 2.9% in the fourth quarter, down to 1.2% in this most recent update. Labor markets
and break-even rates are telling us the markets are doing exactly that. They're looking through the inflation shock and going, on the other side of this is disinflation as demand cools.
And Thomas, I mean, one thing that bolsters this claim is if we take a look at how jobless claims have behaved recently, they've been shooting up. I'm going to pull this chart up on Fred here, if it would allow me, but there we go. Post-COVID, this is now a cycle high for continuing claims. That means people are losing their jobs and it's taking longer for them to find new ones. The pile grows larger. What says that to you about the state of the economy right now? If we're going to have shouldn't it be a good thing that we're going to have someone who's going to be a little bit more rate cut oriented, if indeed that's what the economy is calling for?
Yeah, I think it's good. And the market is, I'm not sure if the market's agreeing with Trump or if it's the market thinks that Trump's will is going to prevail. I think it could be either one. But I think the dollar is the only thing that's really, pointing towards a stagflation environment here. And you have to ask the question, is the market going to start to follow the dollar and what it says, or is the dollar wrong? But, if prices come up from tariffs, and it's looking like some of that tariff impact is coming on to maybe the labor market and prices in the short term over the next couple of months. Maybe we see that through the data more, but the equity market is still saying that, we are going to push past that without too much of a hiccup. So I'm of the view more and more lately that I'm going to get longer into equities and keep a view that the dollar is not going to continue to decline, but it's not going to rebound in any considerable fashion over at least the next 2 or 3 months. So I think that's how I'm going to play it here, by being long equities and maybe long or at least directionally neutral non-US dollars.
Ilya, the price action after we get the mirrored announcement isn't for a NASDAQ to weaken. It's not for the S&P 500 to go down. It's not for risk assets to do much of anything except for going up. I mean, we talk about learning to love it and drop the bomb, learning to stop worrying and just love the bomb, at least Dylan and I do. The market reaction gut here seems to be, oh yeah, we're just going to run this thing hot. You're going to get an easier Fed sooner than later. There's more pressure building internally for an easier Fed. Mm-hmm. And, if we still haven't digested the tariff inflation yet, then maybe lower rates help some businesses secure lines of credit that keeps them open despite the higher tariff levels, which means that more inflation is getting passed through to the economy because there's more vectors for aggregate demand. Mm-hmm. So we're just going to run this thing freaking hot.
I mean, maybe. That certainly is maybe possible. And running it hot would mean that the economy is hot, but it's not. Because we just saw the ISM numbers, which, by the way, the markets, we talked about this on Futures Power Hour earlier. The markets got two competing sets of service sector and composite PMIs this week within 15 minutes of each other. And the first one was really rosy from S&P Global, and the second one was awful from ISM. And the market said, we don't care about the S&P Global one, we care about the ISM. Now, that tells you where the market's head is at, as to what sort of news they're choosing to follow. It's the same thing in earnings, as you've made the point. Downside surprises are seeing a lot more price response, even relative to history, but also relative to current upside surprises. So when stocks see a positive earnings surprise, and this is data from FactSet, they're up give or take what the average would be, a little bit less. But when they get a downside surprise, they are down way more than is the historical analog. And so the markets are seeming to care more about bad news. We saw it last week with the markets fading the Microsoft earnings, fading the Meta earnings, fading the EU-US trade deal. The second quarter GDP numbers were terrible and gave us confirmation on the worst 6 months of consumption since the COVID recession 5 years before. The jobs number was terrible and the revisions doubly so. Inflation is ticking up. The markets are clearly concerned about growth. It's why they want these rate cuts. So I think, yeah, okay, we're going to run it hot. Where's the heat? In order to get the economy hot, you first have to, A, stop doing things that cool it. And number two, you need time. Because even if you were to cut by 100 basis points tomorrow, it would take 12 to 18 months for that to actually show up in the economy.
The market would start behaving like that before the rate cuts are even delivered. They would start,
That's right.
right? So, yeah, the economy might have the bump to it, but asset prices would certainly move there.
Yes.
I saw a great comment from Zero Hedge today, which feels like it's been,
if ever there was a loaded sentence.
Over the years, it has become more loaded. Someone was knocking them like, are you bearish or are you bullish now? And they pointed out the only rational thing to do to this market is swing from extreme to extreme because policy is seemingly changing on a day-to-day basis. So some days it and I actually fully agree with that. Some days it's like, oh yeah, the sky could fall today. And the other days it's like, nothing matters. Just keep buying it. What did President Trump say about how he keeps his stress low? He's like, oh yeah, you do this, you do that. Then an earthquake kills 400,000 people in India. And nothing matters. That's kind of the market's view right now, that it's innocent until proven guilty. I mean, NASDAQ's here up by 0.41% after hours. S&P's back up by 0.02. I can't help but notice it's above the thresholds that make me uncomfortable, a little hot under the collar, leaning short deltas in equities, Ilya. Mm-hmm. Okay, Thomas, so how are you arriving at the place from a technical, quantitative, what's the perspective that you have that you should be just shutting up and embracing the Radigan worldview of nothing matters, we're underestimating the good things?
I mean, that's kind of what I'm doing it through. Sold a put spread in NVIDIA. I think I'm going to get a little heavier into the SMH type plays coming up into next week. I think Tuesday we get inflation data, right?
Yep.
So, if we get through that just fine, and even if we don't, if we get hot inflation, it's still going to be around 2.9, 2.8, somewhere around there. The market's known that we're not going to get, inflation coming in too much, especially with these tariffs. And, the chips are doing well. We get these exclusions from the tariff announcements. I think that's going to be the place to do it for at least the next few weeks. So that's going to be where I'm putting my money at. And it's just, staying above the NASDAQ on the 9-day, the 21-day EMA. I think there's definitely risk to the downside that you have to be cognizant of. But I'm just going to, play this long. And, we've been in a market where the dip buyers are coming in on the dips. And, you come in on the dips, you sell the rips, and just keep doing that. I think it's a return to what we've been doing earlier this year.
Gosh, August and September scare me so much. Volatility goes up. Christopher loses money. That's been my life the past several years. Okay, so we have a S&P 500 that's doing a doji dance at the midpoint of its trading range over the past several weeks. Really, we can call it 5 weeks long at this point. We're finishing up the first week of August. We've been here since the first week of July. So 4 in July, 1 here in August so far. Ilya, we had the move today. You and I were talking on Futures Power Hour about how we could potentially play this over the next week. Does this still feel appropriate? A short iron condor trade where we hold within the sideways trading range that's been carved out since early July? Yeah, that's what a doji in the middle of the range tells me, even with the recovery.
Yep.
Pinned. So I'm not leaning. I still have some longer dated, or I guess relatively speaking, it's longer dated. End of August, S&P 500 puts that were purchased real cheap a while back. However, short term, I feel like the chop just makes the most sense. And maybe I'm missing this, Thomas. Maybe I needed Radigan and you to talk some sense into me. And maybe all the hurtful comments in the YouTube chat when Ilya was gone got to me that you're unfair and unbalanced. I'm kidding. That doesn't bother me at all. But I'm
repentantly unbalanced.
I know.
Because I think as a trader, if you have exposure in the market, you're unbalanced. You're either long or short. And if you don't have conviction in your idea, why do you have it on? And if you do have conviction in your idea, you should not be balanced.
Well, you guys both know I'm unbalanced. You unfortunately receive my text messages every day. So you know what's going on in the world. I do want to bring up something that you and I talked about earlier, though, because I've been looking for an explanation for why the market did what it did yesterday in the bond market. And I couldn't find anything.
What a weird thing it did. I couldn't find anything either.
Until our friend of the show, Michael O'Sullivan, sent over a link to, I can't believe I missed this, a comment made by @FullCarry, Ed Bradford on Twitter, who we've referenced here and talked about and have recommended as a follower if you trade bonds many times in the past. In his thread, it was noted, looking at order flow on UB, it looked like a sell algo was testing resting orders at the yearly opening print 118 and 24 ticks, a few bursts of 400 plus market sell orders, 5 of them under 1 second, and it dropped like a rock. That is the explanation being afforded for what happened in yesterday's market. Let's go down to the 5-minute time frame there. So it was in UB, and it was this mini flash crash. No one could figure out why. Michael O'Sullivan points us to this tweet in the FullCarry thread as a potential explanation. So thank you for that, Michael.
Yeah, indeed.
But outside of wonky fat fingering trades and making mistakes, which happens from time to time, I question how that could happen in something like the bond market, which is supposed to be so deep and liquid.
In the 30-year future of all things, which is deeply liquid.
Yeah, so it wasn't just ultras, right? ZB's knocked lower, ZN's knocked lower. Like a whole bunch of algorithmic trading just kicks in and starts getting dumped. Does that concern you that the long end of the curve is that susceptible to a mistake?
Of course, I think it has to. I think it has to concern everyone. You don't want crazy things to happen to very liquid assets like this. I think there's a couple of things that you take away from here, though. How immune are other assets? Pretty immune, because you did not see a panic in the dollar. You did not see a panic in gold. You did not see a panic in silver. You did not see a panic in stocks. So you don't see parallel wicks like this. So the market seemingly recognized that what this is essentially a flash crash of some kind of thing. And the market just assumes that and goes, okay. This doesn't have anything to do with us. This is not because of some macro thing or because something else has occurred. So the amount of hand-wringing is interesting. And also, we talked about this a little bit on Futures Power Hour, where the spike holds. There is an apparent breakout past the closing levels, going back, let's say, to early July. We flash back down to the last kind of shelf of former resistance turn support, and then swing right back into the consolidation range that we're in between the July closing high and ultimate high. So spike high. So it looks like the market shrugged this off and basically treated it in a cavalier fashion, which I suppose you have to believe them because the price action is what it is. But you would expect that when, of all things, the long end of the yield curve goes haywire, people ought to be freaking out. And so, on one hand, this is encouraging. Market has a good sense, seemingly, of what's a flash crash and what's the real deal. On the other hand, you kind of start to worry about, like, okay, so if everybody is so complacent, would they know the real deal if they saw it? And then what?
Thomas, I mean, the fragility of the bond market bothers me. It says that it's pretty illiquid right now, that we could have a flash crash like that. Of course, if you were able to buy it up yesterday morning and you were watching, you made out like a bandit. But folks don't seem that interested in the long end of the curve all of a sudden. You and I talked about the 10-year note auction yesterday on Futures Power Hour when we were on air together. Today, Ellie and I were able to talk about the 30. Both were bad. Yesterday was a D, F grade. Today's just a straight F. Bid to cover ratio of the past 6 auctions, 2.4. Indirect bidders, 61.9%. This auction, bid to cover ratio, 2.27. Indirects, 59.5%. 2.1 basis point tail. Demand is down. Foreigners not showing up. Do we need to look at the 10s and 30s auctions this week with a more of a raised eyebrow and say, could this possibly have anything to do with the tariffs that are being imposed at the end of this week that just went into effect today? Should we be worried about another late March, early April market for bonds is what I'm alluding to.
We're going down late March, April?
Yeah.
And I mean,
we're going into April, and then.
I don't think so that much. I think the market is going to stay more focused on the changing Fed landscape, the political pressure on it. I mean, if inflation starts ticking up from the tariffs, what does the Fed do now? Do you raise rates? I mean, is that something that's off the table? I mean, do you do that if you're on the board, if you know that the landscape is going to change next year and you're going to be politically more prone to just undo that, even if the data isn't making sense anymore? I mean, I think it's a confusing market to trade bonds right now. So I got out of my ZB long yesterday. I went through some pain on it for a couple weeks. I held it and thankfully got out with a good profit on it. But right now I'm going to stay out of bonds. I still have to unload my long ZN position. I'm nearly unchanged on that after coming out of the deep red. But I'm going to get out and sit on my hands for bonds for until at least this inflation data comes next week and we start seeing more of, is this top that we've made out, is it going to hold? So right now I'm just going to sit out of bonds for a little bit. I'm a little confused by all of it. So just going to watch.
For bonds, at least in ZB, it has been one of the things that's working out here right now. Yeah, that's this one. The short put spread. The short iron condor. That's at least kicking still. The long calls are garbage. The two are balancing each other out. So at least I have that going here for me, Ilya. But with ZB, this is the halfway mark of where we've traded from the yearly high to the yearly low. So what's the trade? A 5.5 IVR is not the sexiest, most attractive thing in the world if you're looking to sell vol, but you got to take what you can get. It's still going to give the 3-to-1 risk to reward type of neighborhood. If you were to go 2 points wide on either side of the 1 standard deviation move, right? Just wrapped around like I have here, risking 3 to make 1, 62% probability of profit. Simple yeoman's work, not the most alluring trade in the world, right? But if we stay around and shop, as bonds seem destined to do right now, then it should work. And I think that's reasonable, right? I did get a question yesterday. It was actually Business Insider reached out to ask me, could the impulse from the data centers, the fiscal impulse from the data center spending, subsume, overtake the cost of the tariffs and vice versa? So I did some math on this. Projected capex on AI in the United States is around $400 billion over the next year. Tariffs are running for the 50th percentile American household just over $2,000. So if we have 130 million American households, you're talking about 260 billion in tariff-related expenses that were not there over the last year. Mm-hmm. So technically speaking, yes, 400 billion in AI capex is greater than 260 billion in tariff-related expenses, but it's only a net of 140. So you're not absorbing all of the capex from AI. I would also question that we're not seeing AI capex spending flowing back into household wealth creations. Data centers, according to the BLS, are not provoking significant turn higher in construction jobs in the areas in which they're being built. Data centers do not take a lot of people to employ. So while municipalities are welcoming them into their communities because they provide a large tangible property tax base, what the real effect is in the short term is that in places in areas where data centers have been built, according to the CPI data that we just had last month, electricity prices are now 6% higher. So you sprinkle in the tariffs. You sprinkle in tariffs. We think about the fact that America has consistently not done enough over the past 10, 20, 30 years to build out its grid. That doesn't mean more oil. It means more of everything, more gas, more nuclear, more wind and solar, hydro. So that way we can have a higher base load that is not susceptible to disruption. We don't have enough transmission lines, and we're building all these data centers. So yeah, I'm penciling this out as a win in terms of the data centers bringing more investment than the tariffs are costing, but I don't think it's that simple. I think it's probably a wash. I don't think the data centers are going to have a huge fiscal multiplier effect for where they're being built if the data continues to trend in this direction. So do the data centers really help the economy? It's not really more jobs.
Well, so this is what I've been harping on for a while with this, is that there is this picks and shovels phase in the build out of any new technology, anything that you're hyped about, anything that you expect to be transformational. I mean, obviously, we're not talking about incremental technology. We're talking about big transformative changes, telecoms, railroads, AI. And that at some point you get to a place in all of these narratives where historically, for as long as we have records, going back to the founding of the original 13 colonies and the speculative bubble around that, when you see all of these things occur, there is the, oh my God, this is the future phase. And there's lots of hype. And there's a build out, and then you invariably find that the hype brought you to overcapacity relative to the incremental dollar of immediate growth to come out of it. That you have all of this future ready stuff, but not demand and not ROI immediately. And then everything suddenly looks expensive. There's a wash. And after the wash, think .com bust, think railroad bust, think the South Sea crash, on and on and on and on and on. Invariably, you get to a place where you go, well, prices are cheap and the great and powerful future has not been dismissed by anyone, so that's the bottom, let's go. And then, of course, you get the long runway for things to get adopted and become the transformational technologies that they were always going to become. AI is more vulnerable to being near the top of a hype phase than, let's say, far away from that top.
I mean, I go back and forth on this almost on a daily basis, depending upon what data is in front of me. And I can't ignore the fact, I mean, this goes to that K-shaped recovery, right? These companies are spending hand over foot. It's going to make them buku bucks. They're going to get filthy rich shareholders wearing white bathing suits on their white yachts kind of success. I don't know why that comes to mind. But the real impact is nothing, because it's not like there are people working in the data centers and helping build the data centers that are leading to proliferation of, well-paying jobs where people can work and put a roof over their family's head as a result of that labor. So tech gets wealthier, K-shape. Labor does benefit. Meta gets filthy rich. Okay, so Thomas, this doesn't seem like a bad thing then, right? Meta is up here, Microsoft's hanging around, Apple got a little bit of a lift. Apple's looking like it's really hot right now. Talk about breaking the downtrend it's been in this year. That wasn't really on the table a few days ago.
Mm-hmm.
Surely if Apple can rally, Thomas, what's stopping us? Why shouldn't I just get out of all my short exposure like Ilya's convinced me to get into?
Well, you should.
Join you. Oh, okay.
Yeah.
Just that simple?
I mean, Apple is really, it's helped carry some weight in the market over the past couple days. Going back a couple of years ago, just even before the AI stuff, you normally would always expect Apple to be higher when the market is going higher. And vice versa, you'd expect in market down, Apple's down. It's just such big weight on some things. But the exemptions from the tariffs, is really a big driver. And investing in the U.S., they said they're going to invest money. Maybe they don't get the best return on capital doing it here than they would somewhere else, but it appeases certain people. And that's, whether they're doing it because of that or, longer term strategy, I don't really know. But, and the market likes what Apple is doing the past couple of days. The exemption makes sense to buy it right now, clearing out, the billions and tariff related expenses they would face if not. But I think Apple is also, they're starting to dip their toes more and more into this AI thing. And I think that's just going to push forward the rush to get into the space and go, the pedal all the way to the metal on this. So like the picks and shovels thing on the AI, I think one of the big constraints is energy. So you need all this energy to power all this quarries and stuff. I think natural gas is going to be one of the things that really benefits over the next few years from this, because natural gas, you look at it, it's an underpriced commodity versus other things. So, investing in natural gas infrastructure right now to fuel this, expected increase in demand from these data centers is more than likely going to drive a lot of energy demand over the next few years and beyond that, 5 to 10 years. So, there's a couple companies, for natural gas that you could be looking at. I think maybe those are good long-term things. I don't think they're really reflecting it yet in their prices. Some things are. Oklo is a good one, modular nuclear reactor technology, things like that. All this investment into AI is going to come with a lot of investment into power plants, utility infrastructure, et cetera.
Yeah, the upstate near Rochester, there is a nuclear, I think it's called the Ginny facility. It's been around since like 1971. I think the entire nuclear facility is like this ball field. It's incredibly small, and it generates power for like 500,000 homes in the area. So why not do a bunch of those everywhere? They clearly work. I digress. Ilya, take the baton here for a quick second. Go over to the world of oil right now. I know it didn't do much of anything today, but fall. It seems to be changing right now in terms of how the market's treating it.
Well, so one interesting thing about oil that I think really bears mentioning today. Positioning wise, I don't think you have much of a change. You have a little bit of a break of an internal range, and we're still testing basically this sort of axis around where the broader range has been oscillating. So we're testing the underside of it, but we're not really breaking through. If you want to kind of eyeball where this is. You can anchor against September 2024 lows around 63.30, and then the top of the range that we carved out post Liberation Day, call it mid-April through beginning of June, around 62.20, something like this. So in there, there's a kind of a band, a kind of 62, 20, 30 to 63, 30, 40, 50, something like that. And you're coming into the bottom of that. We're going to test it. We're going to see. I don't think the risk reward is very good to do much of anything this way or that. But until it is. But the really interesting part of this is we seemingly have escalating tensions between the U.S. and Russia, because the president seems to really want to run into the direction of some sort of a pressure campaign to get Russia to sign a ceasefire with Ukraine. He's grown louder and more impatient. And then today, on top of all of this, we get the news that Israel is going to proceed with establishing military control across Gaza. And oil could not care less. There is absolutely zero attention being paid to these geopolitics. Now, it's not necessarily the case that these geopolitics are relevant, and you can very much make the case that they're not, because neither of these developments are really going to disrupt oil supply or demand, in my mind, in a direct sort of sense, especially in the US. But also, when you've had stuff that's emerged out of these theaters that's been headline grabbing, oil has been the same kind of reflexive jumpy that, for example, gold is. Even though there's nothing particularly geopolitically safe about gold, when geopolitics gets hotter, gold goes, whoa, okay, and kind of livens up. That was not what's going on with oil today. So while I don't think that I really buy a directional bet there right now, because on the one hand, you're near support and looking like you don't have the risk reward really to be a seller. On the other hand, you also don't have a reversal signal to meaningfully go long. So I'm standing aside. But just contextually, the price action today seems to me kind of mildly bearish flavored.
So, Thomas, I do think it's worth talking about the gold move here because it continues to run after hours, 3477.60 right now. This is the continuous contract. This would be an all-time closing high for gold prices. Why wouldn't we just want to get on board? I mean, I think you said you're getting ready to get long yourself. Why not right now? This thing looks like it's about ready to pop.
Yeah, I think that's what you do. The price action is telling you it's ready to get on a breakout here. So I was looking at getting long today. I didn't do it, but I'm going to do it tomorrow probably. So and stay long silver.
To that point, I mean, I have a 3,500, 3,550 call spread on right now. It's about a 46% probability of profit, risking a little bit under, well, risking one to make a little bit over two. It seems like it's a reasonable trade in the short term, given what the breakout is starting to look like and smell like. And if you go to Z5, it's not quite there. You want a daily chart, right? High close is going to be, I believe you, Mr. Candlestick. That's 3508.60. So we're not just there yet on GCZ5, but the continuous is poking up. Obviously, you don't trade the continuous. Gold up, silver up, Bitcoin up, dollar down. Ilya, the currencies looked a lot different earlier today when we were chatting. Now everything is, the euro got back to even, which is pretty impressive given what was happening in today's market. I mean, the marked close is 116.55, 505. We're in here at 116.92 right now. Isn't the dollar all we need to follow to understand the state of liquidity and how the market feels about devalued or debased U.S. asset prices?
I mean, that's certainly a part of it, but I think when you look at how well the dollar ultimately holds up today, it's difficult to get particularly upset with some sort of a sell America dynamic. We had meaningful 50%-ish tariffs rolled out today. We seemingly are going to name a White House, let's say, sympathetic character onto the Fed governor's board. All of these things are reasons why the dollar might go, okay, this is getting a little fuzzy. This might be a sell America kind of a thing, similar to April. And you're not seeing that at all here today. The bonds are not cratering, and the dollar is holding up, frankly, better than I would have thought. In particular, you look at the pound, and it's up for its own reasons, but dollar yen is very well anchored. The euro couldn't sustain the run. But look at dollar CAD. Look at dollar Swiss. All of these things are, and helpfully we now have Swiss franc futures on the platform.
Yes, we do.
And we can see that. This is obviously CHF USD. So this is the Swiss franc. It's the same thing, the same story with the Canadian dollar, where the dollar broke out, it's pulled back, and now it's holding the bounds of the range. It's holding former resistance as support. So the dollar is really holding up here much better than you might have anticipated. And I think this sort of goes to this idea that the dollar is once again en route to becoming a haven currency. That you're getting to a place where the Fed is far from cutting. There's not a meeting until September where that could actually become actionable. The markets are convinced it's going to happen. So there isn't a speculative interest there to keep the dollar underwater, where you'd have some room for expectations to go, there's not going to be a cut. Okay, now there is going to be a cut. No, that ship has sailed. It's done. And so when you look at sort of what the dollar has set up here, yeah, it took a wallop on the jobs report because you did go from no September rate cut to backs on for a September rate cut. But the markets are anchored around the same 50 basis points for this year that the Fed told them in June and March and January. So when you look at all of this, December into January, when you look at all of this together, it looks more like, okay, if there's risk aversion, this dollar is going to rally. And it's not going to rally for yield reasons. It's going to rally because money's going to cash. And now that you've diffused the sort of Liberation Day sell America dynamic, and you've realized, oh, we're not crashing the system. We're just going to be very bull in a china shop with how we bend the system to what we want. But we're not going to attempt to self-immolate the dollar and U.S. Treasuries-based global financial order. Well, then the dollar can get back to being a haven. And so I'm watching this carefully, sort of in the context of what I think we're seeing in equities, which is this kind of begrudging hold. And it really is begrudging because it's begrudging in the face of good news. Like, frankly, the stock market, were it to get the same news flow a month or two ago, would be rallying and making highs. And it isn't.
Thomas, I question if like, sorry to interrupt you there, Ilya, but
Yeah.
I think Ilya raises a good point. Like, but for dollar weakness, would stocks be doing as well as they are? And if the dollar is going to bounce back, what does that mean for the broader equity market outlook? But dollar bouncing back and gold and silver going up, that seems like a really risk-off kind of world.
Yeah.
Yeah, I mean, you would expect equities would be selling off in that environment. So I mean, one thing I like about being long both equities and gold, silver here right now is if that happens, you're going to be kind of protected. You're going to have safe haven flows going to the dollar or going into the dollar and gold. You'd have equities selling off. I'm not convinced that the dollar is going to stage any kind of sustainable rebound until tariff risk and things are taken off. So I think you need more clarity. I think if the dollar's railing in a safe haven manner, it's maybe a more dire economic situation. So where the Fed would be even more inclined to cut. I'm not sure I'm there on my view. I can definitely see that happening, but for the way I'm playing it right now, I'm going to be long non-US dollars, long currencies, long gold, silver. And, staying out of bonds for now.
This is the last show of the week, so why don't we end the show on a lighter note? This popped up to me a little while ago, and it came across as very funny. It's about how some cities are handling Waymo and other automatic cars coming in. This comes from Timothy Lee. He's a former Ars Technica writer, so very much in the weeds of self-driving vehicles. Apparently in Massachusetts, in Boston, city councilors are worried that these companies are doing things like, I don't know, mapping streets without community input, and maybe saying that it's triggering that Waymo is going to replace drivers, and what happens if we get rid of all the unions. Folks, in the most strident terms, if we cannot allow another international dock workers union to rise up around electric vehicles and automated vehicles, it's absolutely ridiculous. It's the kind of thing that prevents progress from moving forward. Jobs will be replaced, but we don't want people just doing menial work. It's not fulfilling. Work needs to fulfill people. And I don't think anyone dreams of being a permanent taxi driver their entire lives. So, geez, get it together, folks. Deliver on stuff. Don't waste people's time saying that they have to get a permit to map cities. Go complain to your town board to do more. My town board's doing great, by the way. Safest town in New York State, 2 years in a row. That's that New York pride, Ilya. With that overtime's added time. We'll be back later next week, Monday through Thursday, 4 p.m. Eastern, 3 Central, right after last call. So for Thomas Westwater in Chicago, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. Good luck trading. See you soon.
At Tasty Live, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The Tasty Live research team and on-air personalities post refreshing content updated daily, covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air and not stale takes, visit the News and Insights tab at tastylive.com.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on Tasty Live.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
With rate cuts back on the table, are there any trades that you're watching in particular?
Well, rate cuts have never been off the table, but every time bonds drop, I think they're a buy.
Not really watching any specific trades in the interest rate space. I do keep an eye on, the futures options like the ZBs, the ZMs, the ZTs to see if there's any volatility types of plays that I can integrate into them. Unfortunately, I don't really feel like there is a really great micro future to trade the changes in interest rates just yet. I feel like they need a little bit more volume, but when those get a little more active, that will be definitely one way I will be participating.
Yeah, I am. I would say honestly the dollar trade, and I know that that is one trade that has been very crowded as far as a lot of people are short the dollar. And if you look over the last couple of years, typically when interest rates are higher, the dollar is higher, and we've seen the opposite. So it would definitely be the dollar and how I'm going to trade that based on what happens with rate cuts.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Forbes called us best online for options trading. With stockbrokers.com, we're #1 for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
People are always asking where.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
It's another inconclusive day for U.S. stock markets. They attempt to rally, but then midday gets slammed back to a little changed result. Ultimately, the S&P 500 ends up finishing the day essentially flat. NASDAQ ends up with a little bit more of a rise. Russell basically flat. And so we turn our attention elsewhere because while there was no shortage of news on the menu, the markets are not finding conviction, at least on Wall Street. And with that, we turn to the world's second largest economy and what might be starting to stir there. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we've found here, it would seem, over the course of the past 24 hours is maybe, finally, some signs of life. There was a set of trade numbers that came out that maybe give a little bit of hope to folks that have been looking for China's economy to maybe, just maybe, finally find a way out of the morass that has contained it over recent years. And with that, maybe give a little bit of a backstop to weakness occurring elsewhere. And of course, a little bit of a level of support in the event that the U.S. economy starts to slow. Because, of course, that has been a running concern for markets. And so with that in mind, we're going to look through what this data was, why it looks like the data was significant, and why that may be something that merits paying attention to in the context of what's going on here from a broader macro perspective, because of course one of the key stories that we've been following here has been this idea that basically since the middle of last year, the US economy has been the only game in town. And with anemic Europe and anemic China, it is very difficult to imagine how you don't get into a global recession scenario were the US to falter. And increasingly, especially over the past several weeks, the economic data has suggested that maybe that faltering is finally starting to come together. At least the markets certainly seem to be concerned along those lines. And so what we'll do here is look at the data, look at why it's so eye-catching, and then see if we can't look across the breadth of Chinese economic indicators and see if, in fact, something different is starting to happen, and if it is, what the trade is in that difference. So, the key data. Import and export numbers came out overnight, and we can see that on both fronts, you have much better than expected outcomes. You were looking for a 5% rise in Chinese exports year on year, which you ended up with was 7.2. That doesn't look as impressive as what happens on the imports side, but nevertheless, it is a meaningful beat relative to forecasts, but a beat within the recent range. But it's really this imports number that ought to be grabbing our attention. 4.1% year on year is oceans away from a 1% decline that was on the menu here for expectations. And taking these apart sort of one by one really paints the picture. So these are the year-on-year numbers over the past year for exports, and we can kind of see, yes, this is the third consecutive month of improving export growth. We keep kicking the can down the road on tariffs. There keeps being this impetus to front-run those tariffs, so this makes sense. If this was April, right, we had this surge to front-run the tariffs at the start of the year because we knew that they were coming. There's a leg lower in April as Liberation Day and things like that took their toll. Another leg lower into May as the dust settles. And since then, sort of the perpetual kicking of the can has helped us to kind of start this recovery. But ultimately, we're kind of mid-range on where we've been, and so there isn't anything to scream too loudly about. It's a different story when we get to imports, because one of the biggest things, of course, that has held China back has been the persistent anemic state of domestic demand. And so you look at this then, and you see this jump of 4%, and it is very clearly a strong departure from anything that we'd seen for a year. Last time this looked this buoyant was July 2024. And this might be something of a game changer if it is in fact pointing toward something that is lasting and something that is indeed rooted in domestic demand starting to perk up. Now, on the export side, things are relatively easy to explain. When you start to look at those numbers, what you see is that shipments to the U.S. are actually down. And that's, of course, emblematic of what's going on. But when you look at what's going on with some of the other key destinations, shipments to Taiwan up 19%, Shipments to Australia up almost 15. Shipments to ASEAN up 16.6%. Shipments to the U.S. fell 21.7%, excuse me. So and that's after a 16.1%, all these numbers year on year in June. So it looks like there is a reorienting of these supply chains. We'll see what the White House does with secondary tariffs, but you get the sense for why exports are creeping higher. The pathway to get stuff from China to the US seems to have elongated and now runs through these ASEAN economies as a middle step, maybe through Australia, maybe through Taiwan, and creates a sort of situation here, maybe, where things can even out. When you look at the imports side of things, that's a different story, because you get the sense that maybe domestic demand is finally starting to get a little bit of life from all the stimulus that China has introduced. Because as we can very clearly see here, foreign capital allocation continues to flee China. This is foreign direct investment year on year. And you can see that although the pace of decline has cooled somewhat in the middle of last year, we were looking at just absolutely eye-watering levels here, around 30% year on year. Now it's kind of anchoring around 10, but that's still a tremendously powerful capital spigot, wide open and leaking money out of China. But at the same time, this credit impulse index from Bloomberg that measures the share of new loans in GDP, that's showing a little bit more activity. So you're starting to get into positive territory here. The level is a little bit higher, so now we have a positive contribution from new loans to GDP for the first time in quite a while. Over the past several months, that's started to move. And the year-on-year rate for how quickly it is growing, that seems to be picking up as well. So maybe, just maybe, all of the stimulus that China has delivered over the past, really over a year, maybe that's finally starting to rouse domestic demand. And whether it is or not, we're going to be able to see as we look at what households' preferences have been. One of the critical considerations here for looking at what's going on in China has been not just whether there is take-up of new loans with all of the easing that we've seen, but whether that money is actually being spent to generate demand. And the story has been, frankly, disappointing. Now, at the top there in the yellow, we see Chinese household deposits, time and other sort of similar deposits, and then in the red, demand deposits. So consider this as a kind of difference between demand deposits being sort of money on hand now, checking accounts type deposits, and the yellow time deposits being savings and CDs. So basically accounts designated to saving, to holding money over time, less liquid, not earmarked for immediate kind of pocket money spending sort of cash. And what we find is that there was a kind of range for how much capital goes to one versus the other. This is a ratio of the two that prevailed from the global financial crisis into the COVID recession. And for essentially 12 years here, there was not a whole lot that changed. It was fairly steady, fairly even. And once you get the COVID recession, you get this of course, lockdown response from Beijing authorities. And there is this dramatic shift where households seem to have lost confidence and are inventorying money, stockpiling money, and refusing to spend. And that, of course, is a huge, huge headwind for China's economy. And we can see here, I mean, these levels are the highest. This is the biggest disparity in favor of saving versus spending on record coming out of China. And so if all of this is going to work, if all of this new borrowing actually turns to action, it's got to get spent. And we're going to have to wait and see to know if that's occurring here. But so far, it hasn't worked. Now, if we looked at the most recent PMI data, this is the official numbers from China's Federation for Logistics and Purchasing, as well as the NBS. So these are official government figures. We can see that for July, we basically have standstill. It's a very interesting set of figures here to look and say services and manufacturing are lower than the composite produced of those things looks like. It's an interesting statistical development here. How that composite number is north of the services number is an interesting data quirk. But nevertheless, everything is hugging the 50 level. And that, of course, is neither growth nor contraction in the logic of PMIs. That's standstill. So it looks like China's economy is idling and basically has been idling since it settled into standstill in the back half of 2023. This right here is the reopening from COVID restrictions. So you can see that there's an initial surge in demand, but then that very quickly fizzles by the end of the first quarter of 2023, and the economy basically settles into this lifeless drift. But when you look at the numbers, competing PMI numbers, structured the same way from S&P Global and Caixin, what you find is that at least on the services side, you have had a little bit more, whereas manufacturing still very much anemic and indeed was in contraction territory in July. This perhaps begins to dovetail a little bit with what we're seeing on the import side. So maybe, just maybe, Chinese domestic demand is starting to appear. Now, these are flimsy things to hold on to for the moment, but they are nevertheless eye-catching, especially as we head into this tariff deadline for the U.S. and China next week, and it does appear like there is a taste for some sort of a deal at the White House. Now, of course, what all of this is aiming to overturn is this apparent total lack of demand appearing in China's GDP numbers, and indeed, most recently for the second quarter of 2025, the problem has only deepened. So we've gone over this a bunch of times here on Macro Money, but we will do it again just to make sure that we're all up to speed here. This is a little bit woolly on the economics analysis side of things, but what we have here in the solid line is real GDP, and in the dotted line, nominal GDP. Real GDP is nominal minus inflation, yet it is running hotter than nominal. So you can see here the solid line is above the dotted line, and that's been the case for 9 consecutive quarters. This right here is the spread. And what you see here then is nominal minus real in normal circumstances gives you positive results because nominal is running higher than real. And in this circumstance, because real is running higher than nominal, their difference is negative. And why is this significant? So nominal is all of the economy's output without adjusting for inflation, the value of all of the economy's output. But some of that value isn't more goods being made, some of that value is inflation. So if there's more demand, and let's say last quarter you sold 10 things, and this quarter you sold 10 things, but the value of the 10 things you sold this quarter is higher because more people wanted them, nominal GDP is going to look like it rose, even though you only sold 10 things again. To get a more accurate view then of output, you strip the inflation component out of the equation, you end up at real GDP, and you go, okay, sold 10 things last quarter, sold 10 things this quarter, nothing has happened, we're not going anywhere. Now, what then it means that real GDP is running above nominal is that that inflation component is negative. So maybe you sold 10 things last quarter, and maybe you're trying to sell 10 things this quarter, but they're not selling because there's not demand. And there's a price adjustment, a kind of discounting to try to entice buyers back to actually buy the stuff. And so when you see this negative coefficient on the GDP inflation component, the implied inflation component, what you're left with is there is no demand. There is oversupply and not enough demand, and that's why prices are falling. They're falling because of inherent discounting and trying to get demand to appear at some lower price level where inventories can be absorbed, where all the stuff that businesses are trying to sell can actually get sold. If it's not selling, you cut the price. And what you find is that over the past 9 quarters, China's economy has had virtually no demand because prices have continued to fall. And indeed, in the second quarter, that fall was the most pronounced of the series here. Going all the way back, not surprisingly, to the first quarter of 2023, where, of course, this upswell briefly occurs. So, this is the battle. If China can get some sort of domestic demand to finally appear, if they can get consumers to finally start spending some of this money they've been hoarding, maybe this starts to turn. But if this doesn't start to turn, well then, in a situation where the US economy might be slowing, and we can go down the list of reasons, weakest consumption in the first 6 months of this year as relative to the first 6 months of 2020, the COVID recession. ISM data this week telling us the economy is at a standstill across manufacturing and services. The jobs report showing woefully fewer jobs created than anticipated and dramatic revisions lower to prior months. On and on and on it goes. If the US economy is in fact slowing, the problem since the middle of last year is standstill in Europe, standstill in China. And between those 3 economies, the US, the Eurozone, and China, you've got 58% of global GDP, and the remaining 42% are mainly vendors to those 3, which means those 3 are where demand comes from. Those 3 are what keep recession at bay. And Europe and China have plainly not been carrying their weight. They've been idling. Europe has been on and off flirting with a mild recession, going back to at least the middle of last year. Whereas China has had this issue that we see on the screen, a near total absence of demand. So if in fact we are seeing signs of life begin to stir here, then we would need to start to see it and that, of course, begin to change the landscape. on a macro level to something a lot more encouraging. We're going to find that our next indicator on this over the weekend, where China is going to produce its latest inflation data. The expectations here, as we can clearly see, are not exactly rosy. The upshot is that we are going to get another negative reading on CPI and another negative reading on PPI, wholesale inflation. Of course, that one is not terribly shocking. In fact, it's been in various versions of negative territory going back to before the reopening from COVID in 2022. But this would be the key here, this CPI series, because it would be here that you'd look for a little bit more of a demand pull on inflation. If, in fact, consumers are starting to wake up, if the pickup in imports is something with legs, if the pickup on the services side in at least one set of PMI numbers is something to then pay attention to, and we're starting to get a little bit of these data points coming together, then what you'd expect is a higher CPI number, better than expected in some way, shape, or form. And if that's the case, well, maybe we're finally starting to find some opportunities in Chinese markets. Now, we can see here, this is the CSI 300 index. This is essentially China's equivalent of the S&P 500, a sort of catch-all for the most significant listed names on exchanges in Shanghai and Shenzhen, the two important exchanges. And we can see here that the last time this really stirred was when it looked like there might be big fiscal stimulus on the menu, or at least appetite for big fiscal stimulus had occurred, with the hope that it would create consumer demand, which is, of course, exactly what we're talking about. Now, we can see that that hasn't materialized and we've been idling. But perhaps it is still on the menu to appear. So if we can take a look at sort of where the tops and bottoms on this range are, if we can get through here, if there is in fact a sign in these markets that perhaps we're finally getting to something like relief and there is a break this way, well then, first of all, of course, Chinese stocks and ETFs like FXI and ASHR and other reflections of Chinese demand, maybe the Australian dollar, that suddenly starts to look interesting. But from an even bigger macro perspective, you perhaps have the kind of backstory, finally, where you're not so worried about a U.S. downturn from a broad risk sentiment perspective, at least to the same extent, and then maybe, just maybe, the architecture of the landscape for Wall Street starts to change, where it's not that you have to hope that the AI bubble keeps inflating, it's that you can actually have some confidence in underlying growth itself being better than just hoping the US doesn't misstep. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm back with Chris for Futures Power Hour Mondays and Fridays, as well as for First Call alongside Tom on Sundays, writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money will be back next week. Happy trading.
Dear Kaylee, hats off to you for being such a culinary genius.
I don't think it has ever dawned on our kitchen staff to serve gazpacho hot. Sincerely, Bob.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
I don't want to fact check you with my vagina, but I will.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap.
First of all, I'm sitting in the captain's seat. I've never been invited to come sit in the new captain's seat. But what I'm concerned with is the size of these screens. And then he's still doing this.
Snow, let's take a look. They did not hold that rally at all. Phil, you got a partial.
973.75. I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could like swivel his head. He has to see the screen. He has to go like this.
To me. And then, you know what? Money goes to money. You did it. Good job out of you.
Yeah.
I just drove with him twice. Now I'm really concerned that I was just in the car with him for 2.5 hours.
It was a great show, very inspirational and motivating.
I feel like you got to know each of the traders a lot better on a personal level. It was awesome.
This is my 10th or 11th live event. I thought the math was really complicated and it wasn't, and then it just made sense.
They've opened my eyes to many different strategies.
And I realized there's a reasoning and strategic planning that you could do to be successful. I love all you guys.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Craig in New York City, what's up?
I just want to say, I've been with you since the very early days of Thinkorswim, and traded all kinds of markets here and there. And I got to say, I could be off so much worse if it wasn't for what you guys have sort of drilled into me over years and years and years. And so I just want to thank you, because you could have easily just taken the money and run when you sold Thinkorswim, and you didn't, and you started this. And you basically have just given me this full education in this thing that was completely foreign to me many, many years ago. And so even though I've lost money in the last few days, you've saved me a lot at the end of the thing. It's like losses could have been catastrophic, and they're not. So I appreciate you.
I hear you.
I appreciate you guys. Thanks so
Thank
much.
you, man. And I appreciate you holding on the line to say that to us. So thank you.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Trading is hard enough. Here's what liquidity is. You want to be like water. Liquidity is in reference to how easily you can get in and out of a position, from volume to open interest, to actual price at which you can buy or sell your position. It's important for all traders, from stock traders to futures traders to options traders or even crypto. Tight bid-ask spreads and high volume are characteristics of good liquidity.
On today's Trader Taste Test, Tom has a fever, and the only cure is the KFC Chizza. What? Let's go.
Let's see what we have here. Okay, I don't think it's elevated chicken parm, okay? I don't know.
What are your thoughts? Just visual presentation.
He's just going in with his hands.
It's pretty beautiful.
Let's see. I'm going to be totally objective.
Okay.
Impossible.
Okay, Jamal, you're black. We're eating fried chicken.
Yeah, right. I knew it was on there.
It's warm.
No. I like it. It's hot. It's delicious.
It rivals the chicken parm in prison.
Out of 5 stars, what do you give it?
1. I'm going 4.2.
Wow.
I'm easily impressed, as Tom will tell you, though, but I think it's very good.
3.5, just because I like Kentucky Fried Chicken.
Come on. Do you want to be KFC style?
3.7. I gotta be real. 3.7.
Okay.
Because the chicken's good. I mean, the chicken's not bad. The sauce tastes like pizza sauce, like bad pizza sauce. I like it.
Out of 5, what do you give it?
3.5.
That's what you do. What?
He likes it. 3.5 stars. He doesn't like it a lot. Is what he's trying to say. It's an elevated. It's an elevated. It's an elevated nothing. It's a chicken. It's actually pretty good.
If you missed the live show, here's our cherry on top weekly recap.
First of all, I'm sitting in the captain's seat. I've never been invited to come sit in the new captain's seat. But what I'm concerned with is the size of these screens. And that he's still doing this.
Snow, let's take a look. They did not hold that rally at all. Phil, you got a partial. 973.75.
I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could like swivel his head. He has to see the screen. He has to go like this.
To me. And then, you know what? Money goes to money. You did it. Good job out of you.
Yes.
I just drove with him twice. Now I'm really concerned that I was just in the car with him for 2.5 hours.
Eddie in Texas, what's up?
I'm trying to determine whether or not I should actually feel experienced enough to grow my account. Been trading for about 1.5 years, done all the homework. I'm not sure if it's just a market that I got lucky in the past 2 months.
Like, how many trades have you made?
This year so far, about 100.
Yeah, so if you've made 100 trades and it's working for you, then that's not luck.
No.
That's not getting lucky. That's being freaking smart and doing the right thing. Because you took advantage of an opportunity is not getting lucky. You made 100 trades already. Back when we started building this kind of software, an active trader made like 20 trades a year. What used to be 5 years, you've packed it into a few months. I mean, I wouldn't discount anything that you've accomplished so far at all.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Yes, how we doing, brother?
Feeling good. Yeah, Starbucks made a move that I needed today. My DoorDash risk of the week did not pan out for me in any capacity, but we managed to get out of that. You know, it's always nicer when you lose a trade and you're still able to get out of it, as opposed to, like, especially in a super binary trade like the one that I had on DoorDash, getting stuck with it and it's just at zero and you got to sit there and look at it all day.
I hate that. Sometimes I'm closing this up. 2 days left. I'm trying to just get this out the.
Hey, I'll do that too. I'm like, will anybody pay the penny for this position? Like, please, somebody give me a penny. So yeah, but holistically, yeah, good day for me in the market. Feeling good. Vibes are high. Week is drawn to a close.
I mean, I feel like
2 rounds of golf playing this weekend.
2 rounds of golf. I was eavesdropping earlier. You hit a birdie as of recent.
I did.
Let us know a little bit more about that.
I did. Yeah, made a birdie on a par 5. Birdies, they don't flow very freely in my golf game. It's sort of a few times a year type of situation. But yeah, played actually one of the better holes of my entire life last weekend. It went, it was par 5, and really it was just the second shot with the 3-wood hit like a beautiful 220 yard, rolled right up onto the green, set myself up nicely. Had an eagle putt. From very far, but yeah, managed to lag that up. Get a birdie home. It's a big deal when Gus makes a birdie. That's cause for celebration. So yeah,
I like that. I haven't been golfing yet still, but I don't know how well the Wii golf translates to real life. But if it's close any at all, you might be hitting some birdies
here.
Here.
You go to the driving range sometime. You can swing my clubs around, see how things are feeling. It's a tough sport, and
it is a tough sport. So you got to really mentally lock in on that. And exactly what I'm trying to do with some of these positions in the portfolio, guys, because Eli Lilly really. Really bad today. But anyways, some news coming out with Eli Lilly and a lot of those weight loss drugs not looking too hot. We talk about the weight loss drugs. It's like a cycle.
It is.
Every decade we have some type of weight loss drug kind of company trying to do something. I don't know what it was like 5-10 years
back
ago.
when we were a proper country, you just got
back when we back. That's funny. No, but other than that, we've had a pretty crazy week over the last couple of weeks. We're finally getting some earnings out of the way. We'll be able to put in more positions of the sort on that. I know I got some positions to manage tomorrow. Before we get into the segment, anything else on your end?
Yeah, no, I don't really have anything else on my end. We're kind of drawn to the end of earnings season here, and I think we're
thank goodness
pretty much all the Mag 7 names. But yes, thank goodness. It feels like it'll feel like 1 month until we're just right back here again. A couple of chats here. Edward, I've never had an eagle either. The day may never come. We'll see.
Not with that attitude.
Drinks all around when Gus gets a birdie. Yeah, I'll buy everybody around. Let's do it. Everybody, let's link.
That's no eagle or birdie with that attitude. Come on, we're locking it in. Let's go.
The birdies come sometimes. Okay, Eagle, that's sort of a different level. I don't know if I'm ever going to get there. We'll see. Also worth noting, I shot 120. Shot 120 with a birdie and 3 pars, and I shot 120. So I'll let everybody draw their own conclusions about how that can happen. But yeah, let's jump into these slides here. We're going to talk OpenAI. GPT-5 dropped out today. Dropped to the world today. OpenAI released GPT-5. They're making it available to everybody for a short time, and then it will shift to only paid users. It's supposed to be night and day from GPT-4, according to Altman and all of the reports that I've read. And we're going to get into the specifics here a little bit. See. But we're also going to talk about some broader societal implications of AI and where this trajectory may be taking us, which is a very interesting conversation. So we can jump right in. So first of all, GPT-5. You want to take this one?
No. What is GPT-5? What are we getting into?
About it. Yeah. So this is the successor to ChatGPT-4. OpenAI is ChatGPT. I know these all get very difficult to keep up with the GPTs and the Claudes and the DeepSeeks of the world. They get mixed up. It's multimodal by default: text, images, possibly video, audio. OpenAI also has the VO suite, which is their video generation suite. Longer memory, rumored to support over 1 million tokens. Really? Is that right? Damn, that's that's a lot of tokens.
Right.
Stronger. What is that? Stronger agentic capabilities, multi-step tasks with less guidance. And the agent features are kind of what I'm most excited about with this update, actually, and we'll get into that in a little bit.
Okay.
But I think that's sort of the next level that chatbots can take on a retail individual sort of basis. It's also more personalized, better memory for user preferences and context. That's another factor that I'm excited about because I cannot stand how often I have to remind ChatGPT things about myself. And honestly, that's kind of a crazy statement I just made that I want this thing to collect more data
absolutely.
on me.
That's on.
But man, it would really ease my experience if it does collect some more data.
Yeah.
Everybody has my data anyway, so who cares? And then lastly, more energy efficient. This is obviously something that they were trying to address. There's lots of conjecture online about how much energy these things take. And also, let me just say in no uncertain terms, I don't know where this like 5 gallons number came from. It does not take 5 gallons of water to do one search query on ChatGPT, you guys. It's like nowhere close. Furthermore, the water does not just go away when they use it. They reuse cooling water over and over. If it does evaporate, then it just enters back into the water cycle. So lots of water usage, yes, but I think it's become a bit exaggerated.
Yeah. I gotta say, I think I'm really excited for the improved reasoning, speed, and the consistency. ChatGPT is great, don't get me wrong, but sometimes you have to remind it with certain reasoning capabilities, and then sometimes it'll hit you back with you're absolutely right.
Yes.
Great catch.
Yes.
You know, so those type of capabilities I've always been intrigued with. I know Sahil, sometimes he'll play around with asking it questions and try to like break it. Like, now respond to me, and trying to like work around it, and it always has some smart function. It gave us the thumbs up when we said for it not to speak with us. So
that's funny.
The reasoning capabilities is always going to be exciting.
I'm definitely excited about that as well. And also, I know that something that was expressed by Altman in his press conference today is that it's going to do a better job of telling you when it cannot do something. Okay. Which I think that is also going to be
right.
You know, a big time saver, because I recall in my senior year of college, I was trying to do some super high level thing on Excel. It was econometrics. Like we had a bunch of data from a study and we were trying to apply it. It's not really relevant, but I was trying to have ChatGPT aid me in developing this Excel, and I came to find after more than an hour of trying that it simply could not. The capabilities just weren't there, and I could have been saved all that time if it just said, I don't know how to do this, and that would be good. And then beyond that also, just it seems like it's going to be much more careful. I feel like, especially when you have it do something in a web search capacity, it will often really get dates mixed up or give you very 100%. Old information that's not relevant anymore. Like, for instance, earlier this year, I was writing an article for the magazine, and I asked it when Brian Niccol took over as CEO of Starbucks from Chipotle. And it straight up told me, you are mistaken. Brian Niccol is the CEO of Chipotle. The CEO of Starbucks is the old one. I don't remember the guy's name. And then I had to say, no, Brian Niccol is the CEO of Starbucks. Then it hits me with oh, you're absolutely right.
Right, you're absolutely right.
I appreciate your attention to detail. So,
but you see how it hypes you up, validates you first. You know what I mean? And then lets you know.
It does. And I honestly feel like that's a big problem that it's had this entire time as well, is that it leans too much on the side of validation. When
100,000%.
Asking clarifying questions could be very valuable.
Yeah.
It just really wants to do exactly what you want it to do. And even sometimes I will say, please ask me some questions before you dive into this process, and it does not listen. Yeah. It just starts going.
I know. I think I'd seen a tip online. It was talking about how to communicate with your ChatGPT. One of those tips was telling you, like, please be very objective about this. Give me different angles of reasoning, thought processes, and all the things of this sort, because it does have a little bit of bias built into it. And as it learns us, it has our own biases.
Which is what scares me when I hear people talk about, ChatGPT is a great therapist. Right. It's like,
bro, this
thing is just going to validate whatever you say.
Well, this is why I thought TikTok was an extreme echo chamber. It's because no matter how we're feeling, no matter our opinion or viewpoint, it's going to put you in that box to where you hear the same opinion. You know what I mean? An extreme echo chamber, for the better or worse. I think it could work on both sides of the spectrum, but we'll get into the second slide here.
Yeah, we can jump over.
The rise of AI. 1956, AI coined at Dartmouth conference. And as we go through these bullet points, or as we go through these dates, let us know when you first heard about AI. I think you said 2011.
Yes.
I can barely recall mine, but let us know when you first heard about AI. 1956, AI coined the Dartmouth conference. 1997, IBM Deep Blue beats chess champ Garry Kasparov. I don't know anything about the chess champ with AI. 2011, IBM Watson wins Jeopardy, showcasing NLP reasoning. You had mentioned that earlier. Then we got 2012, deep learning breakthrough through ImageNet. 2012 was more so when I started hearing about cryptocurrency, Bitcoins, things like that, but nothing too much around AI. And then 2016, AlphaGo defeats Go world champion, strategic AI milestone, which is huge. I mean, whenever you start seeing AI defeating very sophisticated, intellectually smart people, that's when you're like, yo, AI, this stuff probably has some pull here. And then 2023 to 2025, generative AI, ChatGPT, Midjourney, Claude goes mainstream. You know what I haven't heard about in a while, though? Was it Deep Sea or Deep Blue?
DeepSeek.
Was it DeepSeek?
It's the China one.
The China one. I haven't heard about that one too much. Maybe because we're not in China.
Yeah, they are still churning out new models of DeepSeek all the time. Yeah, they come and go. Is Gemini better or ChatGPT? I think ChatGPT is better.
I would say
at this time, especially in terms of market share, but I believe in general, and especially with GPT-5
and Grok.
And I think it can optimize your fantasy baseball team, Edward. I think if you feed it your lineup, there's probably ways that you could do that. It might need more stats from you, but I have certainly used ChatGPT in, shall we say, similar predictive sports contexts. But yeah, Kasparov is a fellow American. But anyway, yeah, my first encounter with AI in my entire life was 2011 when Watson was on that run on Jeopardy. I just told you the story outside, but for the viewers, I had a technology teacher, computers, whatever, when I was in elementary school, who was a gigantic buyer of AI in the very early stages. Mr. Bailey, if you're out there, I hope you are so rich right now because you were so right about this in 2010. But we had a stretch when I was in elementary school where my technology teacher was super into it, and so every week when we had that class, the day after Jeopardy, he would make us watch the full Jeopardy.
That's fire, though.
It was like weeks and weeks and weeks. It was a crazy run that it went on. But yeah, then they started bringing in like the all-time Jeopardy MVPs to try to beat it, and just nobody could beat it. And at the time, I couldn't quite grasp the concept of artificial intelligence. Like my thought, I simply could not separate my brain from this thing is Googling stuff. That was just always what I thought. But
let me ask you this: how have your behaviors changed? How often do you use Google? Has it changed?
It definitely has changed. I mean, broad Google searches have decreased, but I also I still use Google. I mean, I would honestly say maybe more than most who use LLMs.
You use Google for the most.
Just anything that I think Google can give me a quick answer for is really what it is. It's just like, I don't know. It's marginally quicker, but it's mostly force of habit because it really is no different. It's open the app, click the bar, type in the question.
Yeah.
But yeah, I don't know. It's a force of habit, but anything remotely complex or that I think would even require me to click into a link on Google, I'm using ChatGPT.
I've noticed with Google, it's like if I want to pull up YouTube or another large software or YouTube search, it's always Google. But from there, more complex, like you mentioned, ChatGPT.
I also will use Google if I want. I will use Google to get me Reddit results. that's part of it.
100%.
Yes, because
100%.
Sometimes I just want to hear.
I'm not gonna lie about it. Sometimes when I'm looking for something and I start to see Reddit popping up, I'm like, I'm not gonna find what I'm looking for. Usually Reddit is like the last, and sometimes they come through with the answer you were looking for, like that extreme nuanced.
Oh yeah,
very specific situation.
Like when I was building my PC, like Reddit was the
I believe,
because I had all types of issues getting Windows to copy onto it and getting the thing to actually boot and like post to my monitor, and Reddit was great. There's just 100 people who have had the exact same issue, and there's 100 different solutions presented, and you just sit there and try every single one.
100%.
But yeah, so AI on the come up, as we well know. If you're involved in the market, it'd be hard to not be privy to that information. So that leads us to our broader societal discussion for today, which is the fall of social skills. So for a long time, even predating AI, well predating the prominence of AI, digital communication has been replacing in-person interaction. This is pretty much true since the rise of social media. I'm sure that, I don't know though.
Everybody's parents complained about this though.
Yes,
right?
Yes. Everybody's.
This was like the first gripe.
Damn phone. Right. Yes, exactly. So this has been a thing. AI tools have now begun to even further replace the need for critical thinking, expression, even communication with each other. People are using AI to write their emails back and forth. Empathy and listening are declining due to constant distraction. That extends beyond AI to other topics which we've covered in previous shows. Children's attention spans are dropping. They're putting screens in their hands from the time that they're 2 years old or whatever. People avoid discomfort online, making real life conversations harder. This is certainly true. And I can remember being in like 5th grade, and it was like you had to text your crush. Like you could never actually work up the courage to like go talk to them. And I can remember being in 5th grade and I couldn't work up the courage to talk to my crush in person. I did it over text. Went well, by the way.
There you
know what's going on. But
on Kik?
What?
Remember Kik?
With Snapchat. But yes, I do remember Kik. Yeah. Definitely was involved with Kik. But anyway, I can remember at that age thinking, it's so strange that this is easier over text. Why is this easier over text? I know I'm conveying the same information to the same person. I know who's going to receive it. Why is this easier? And it was something I could never really wrap my head around, and honestly still can't to a certain extent. I mean, it's just, psychology and everything, but it's very interesting, and we're seeing an incredibly pronounced version of that now with the rise of AI. Social media rewards curated personas over authentic connection. That one is definitely true, and we'll get into some stories there in a second. And then beyond that, yes, fewer shared spaces, more screen time, isolation is becoming increasingly normal.
Yeah.
So yes, all of these things are definitely true, and yeah, I think, and honestly, sometimes I even will like have to stop myself as I'm opening ChatGPT and say, "Oh, I'm a person. Like I can do this. I can think about this. Like I don't need ChatGPT for this." But it's becoming more and more instinctive to just turn to that and let it be my brain as opposed to actually using my brain.
Right.
And that's a scary thing because I'm an adult who's aware of this happening. I can't imagine being a fourth grader in school right now and having access to all these things. I mean, you learning just basically becomes a choice. Like it's very
No, it 100% does. And I mean, the other day, I caught myself doing something. I was like, no, let me actually put in the brain power to do that because I started seeing those little behaviors, those little habits, instead of using the brain power to do that. I think it really is dependent on when you use it because at the same time, if you think about it, that natural behavior is just to be more efficient.
Yes.
Like that's really what it is because we lean towards convenience in our DNA. But I mean, I thought the same thing and I kind of nip it in the bud whenever I see those behaviors. I'm like, I have the brain power for this. I can put in 5, 15, 20 more seconds of thought. And then it's also more authentic. And sometimes you can whip up something a little bit better. And if you want that better, then you can spit it back into ChatGPT. But I have caught myself with some of those behaviors.
Yeah, and a major personal policy of mine that I think I will continue to uphold moving forward is that I don't ever use AI to communicate with other people. I will use it to, and then Like I've never had a text written in ChatGPT. Well, actually, me and my friends send meme like clearly ChatGPT text back and forth to each other sometimes. Like we'll make it like I'll say, write an incredibly dramatic medieval sounding thing telling my friend to get online.
Yeah.
And then I'll send that to him and it's very obvious. But in terms of like real legit communication, I'm never sending emails that are written by AI. I'm never sending texts that are written by AI. Everything that I do for the magazine and everything is never written by AI. And so it's just, I think that it's great for support, but I do that because I know that those skills will go away. I mean, if you don't, keep flexing those social muscles, you will lose them.
Right.
We're seeing that, continue to happen.
Well, I know we were touching on the conversation too about the value of in-person conversations. You and I, face-to-face right now, shaking hands, doing all those kind of things. And it's like with the push of AI, and we heard those other perspectives earlier, it's like, will in-person be the hot commodity? Will things actually change? It's like AI was this, AI that, and people are trying to move away to those new opportunities, but the opportunity might land into face-to-face, person-to-person contact.
It's true, and especially as AI agents become more prominent, like in customer service capacities and places that you...
I hate AI in customer service is just one place that I just can't get around.
Oh, really? I'm in the opposite boat. I'm excited.
What do you like about it?
I'm saying let's do it everywhere. I don't know. I really haven't seen very many good examples of it yet.
Yeah.
Exactly. But like when you think about, something simple like a doctor's appointment or calling my insurance company. It just makes more sense if there is pretty much always going to be a binary is not the word, but a defined set of choices at each stage of a workflow. I would rather just have AI for that because we can rip through it real fast. There's no sitting around waiting. Like for instance, when AI says, "Can I have your date of birth and your social so I can verify your identity?" I would say those things, and then it would just immediately be like, "Oh, hello, Augustus Downing."
Right.
But with a person, I got to sit there and wait for them to type and see if they can find it in the system. And it's like, so
I'm getting there.
Yeah,
I hear you. I'm getting there.
But that said, it has to be good.
Yeah.
You can't try to integrate these things before they're ready.
I mean, just to show you how fed up I am with customer service AI, I forget what I was calling a couple weeks ago. Someone picked up and they started talking and they literally had like such a good AI voice. I was like, representative. I was like, representative. And they're like, sir, this is a person. I was like, I'm so sorry. I was like, representative.
I'm sure that's happening more and more. Yeah, but it's just, I think anywhere where there's like, you're getting insane call volumes and there's typically high wait times, like an insurance company after a natural disaster, right? Like everybody's house gets wiped out where suddenly there's a whole city that's calling this insurance company and the wait times are long and all this adds stress. It seems like a lot of those things probably could just be resolved and ironed out with AI in 5 minutes, no wait time.
You would think so.
Yeah, and so I do think that there's interesting use cases for that. I will say to supplement this though, every AI chatbot, like help chatbot, like customer service that I have used sucks, and they suck so bad, and I don't understand why. It's
just a front.
I know.
It's just a placeholder.
It's like they try to be too restrictive, but they wind up just doing the same functionality of all of these virtual assistants we've had forever and ever. Also, let me throw this out there. Bank of America, lock in. Bank of America's virtual assistant, Erica, in the app is terrible. She is so bad. The machine is so bad. Bank of America, please, I'm begging you, talk to any one of these companies with a large language model and let me talk to that thing.
Erica, lock in.
Erica, you gotta dial in, girl. They're gonna replace you if you don't. Yeah.
No, I mean, we'll see the developments of AI and how we come around the corner into the end of the year here. But anything else to add before we wrap up here, Gus?
I will add one more thing here. Mike, I said I hate getting my mail out of the mailbox. I think it's been a month. I also really hate getting my mail. I don't know why, but I'll go like 2 weeks.
What do you prefer? A little slot in your door where it just slides in like the old days? They used to do that too.
Yeah, maybe.
But I mean, then you're gonna have papers right at the front of the door. Slide it under the door.
Just don't send me mail.
I was like, what's gonna make you happy, bro? Just tell me what's gonna make you happy. We'll do it.
Text me or send me an email. That is, we live in the modern age. I can't believe how much paper mail I still get. Yeah, stop.
I feel that. Stop. That's going to wrap it up for today's segment. We always appreciate you guys taking the time to come hang out with us. We'll see how AI ravels on to the end of the year. And we'll be back here next Tuesday at 4:30 Central Time. And we'll catch you guys next time. Peace.